Hey Bowtie Nation, Joseph Hogue here with your weekly market update, 9 a.m. Eastern every Monday morning with the StockstoWatch and the news you need to see. Nation, the US dollar is still holding near 40-year highs versus other currencies like the Japanese yen and the euro, as persistently high inflation keeps those interest rates higher for longer. Cracks are starting to form though, and almost a decade of strength for the greenback, and the dollar's fall could accelerate into next year. Dollar weakness is my most confident theme over the near term, and I've found 5 stocks to watch for when the dollar busts. Stick around after that, I'll show you the stocks I'm watching this week, along with updates to shares of Nvidia and some high-yield dividend stocks about to get a boost. But first, if you've ever wondered what's in my portfolio or want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. The app was created by YouTuber Brandon Beavis for investors and by investors. I just started using it last year and love the app for getting ideas and sharing my own portfolio. And this isn't just another social app though. You can connect your brokerage account or just input your portfolio to track all your stocks in one place. You'll see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 90,000 investors in the social feed to see what everyone else is talking about. I've shared my portfolio on the app and it's totally free to download, so look for the link I'll leave in the description and check it out. Back to our main topic though, and I don't want to go all economics nerd on you, but a currency's strength against others can be a hugely important factor in stocks and investing. Right now, higher interest rates in the United States and the idea that the Fed is going to only gradually lower those rates is drawing foreign investors into the US, creating demand for the currency and pushing its value skyward. We see that looking at the US dollar index, that's DXY, a measure of the dollar's value relative to a basket of other currencies. We see it nearly a 40-year high here. Only after the dot-com bust and in the mid-80s was the dollar this expensive, and most of that 40-year period, the currency was 10 to 20% cheaper. And what you have to understand here, a strong dollar has implications you might not think about for stocks. For companies with sales in other countries, a high dollar pulls down that revenue figure when it's translated from weaker currencies into the stronger dollar for accounting. It also makes U.S. exports more expensive versus foreign competitors, so the dollar's strong run over the last few years has significantly handicapped U.S. companies and the economy. We see that with just under half, about 49% of the S&P 500 companies' revenue is internationally, and as high as 57% for tech companies. A strong dollar can be a constant struggle, but that run in the greenback could soon reverse. We did see a mini reversal late last year when the dollar fell nearly 6% from October through December. At that time, I recommended an investment that yielded a 127% return in just 2 months, and I'm going to include that in today's ideas as well. We could be seeing the dollar break lately with the DXY index down more than 1.5% over the past month, but what I'm watching here is for a longer-term trend into the next year, and that could bring the dollar down as much as 10 to 15% and really move these stocks I'll highlight. The reason why I think this could be worse than what we saw late last year is it is a perfect storm of factors. First, central banks around the world are gorging on gold to divest their money from the dollars. Central bank buying hit a record in the first 3 months of the year and showed the 17th consecutive quarterly increase in stockpiling gold. Political chaos in Congress and the threat of more to come is weakening that trust in the dollar has always held and the faith in the U.S. government. When the Fed does start cutting rates later this year, those falling yields is going to limit the currency's appeal to those foreign investors. This could actually feed into itself in kind of a vicious cycle when it starts. Rates come down and those foreign investors pull back on their dollar investments. It's going to weaken the currency. That means dollar-denominated investments held by those foreigners, they're going to see that value drop as the greenback falls versus their own currency, and those losses would drive more foreigners to pull their money out. Finally, and I'm not trying to get all political here, but President Trump's team has already started making plans to challenge the Fed's independence, even giving the president some control over interest rates. That, combined with the escalating trade war with China, would severely hit global faith in the dollar and could turn into something even worse than I'm forecasting. Now understand though, I'm not predicting a crash in the value of the dollar like so many others here on YouTube. The US dollar is still the most trusted currency in the world, with global central banks holding about 54% of their reserves in dollars, according to the IMF data here. That is almost identical to the percentage in 1999, so despite all the fear-mongering to get clicks, the dollar isn't going to crash anytime soon, but even a pullback of 10 or 15% could have a big consequences for the economy, the stocks in your portfolio, and the 5 stocks I'm going to highlight right now. First up here, the Invesco US Dollar Index Bear Fund, ticker UDN, is the most direct way to invest for a drop in the dollar, though just buying the fund probably won't produce much of a return. The fund trading here at $18 a share is near a 5-year low on dollar strength, but Even the greenback weakness back to 2021 lows would only be a 19% return. And that's why we set up that call spread strategy in October that produced a 127% return, and we're right back in the same position right now. Here, if we go to the options available, and we can use the September expiration options. Now that's going to give us plenty of time to see catalysts to weaken the dollar like lower rates and political risks. Here we can buy the $18 strike call options for about 45 cents each, and at the same time sell those same number of $19 call options for 8 cents each. That's going to offset some of that. That's going to make our total cost of 37 cents per share for the $18 to $19 spread. Now, if the dollar does weaken and the UDN rises back over $19 a share as it did late last year, we get that full $1 payoff on the spread, or as much as a 170% return. Now understand, you don't need to hold those options all the way through those September expirations. If the dollar does start to weaken early and you can get 50 or 60 cents closing out that spread, that is a 60% return in just a couple of months, so I think I'd take it. I've been recommending gold miners or the Van Eck Gold Miners ETF, ticker GDX, since last October as the price of gold reaches all-time highs. Now, I'm not so much a fan of buying gold directly because you earn nothing while you hold it, but two factors put these miners on top here. First is you're going to earn that 1.5% dividend while you hold the fund, and these companies have a great leveraged model to the price of gold, meaning as the price of gold goes up, their earnings go up even faster. Even better though is this all-in sustaining cost, the AISC for gold miners, is so far lower than the current price of gold that gold could fall from its high and the miners would still be strongly cash flow positive. Within these individual miners, we see names like Agnico Eagle, ticker AEM, with its AISC even lower than the average here. Gold not only benefits from the central bank buying that is propelling it to new highs, but here again, any commodity denominated in dollars is going to benefit if the value of the dollar drops. And so we can use that same theme with other commodities as well, using funds like the United States Oil Fund, ticker USO, which holds oil futures, or the Global X Copper Miners ETF, the ticker COPX. Any commodity or real asset, that's gold, oil, copper, even real estate that is denominated in dollars, so priced in dollars, that asset is going to hold its value. So if the dollar does fall, then the price in dollars for that asset is going to rise. Similar to the dollar bear fund, you could also invest in currency shares funds to take that position in other currencies that could strengthen against the dollar. Here we have funds like the Euro Currency Trust, the ticker FXE, the Yen Trust, FXY, or the Australian Dollar Trust, ticker FXA. Now you'll notice that, just like the currencies themselves, these don't tend to move much in absolute terms. Even in the dollar sell-off of late last year, the Euro Trust only made it up to $102 per share, about 2% from where it is now. So I think here I would instead use that same call spread strategy we used with the UDN. For example, buying the September $60 calls on the Yen Trust for $1.55, and then selling the same number of $61 calls for $1.15 each means a cost basis of 40 cents each, and a potential 150% return if the trust finishes above $61 by expiration. And as I mentioned before, those companies with more revenue overseas will benefit as stronger currencies get translated into that weaker dollar when quarterly results are reported. It could be a tailwind for some of these companies to surprise on revenue into the end of the year and next year. For this, we see companies with the most overseas revenue include Philip Morris International, Newmont Mining, which also benefits as that gold miner. You've got a lot of tech stocks here on the list with Qualcomm, Skyworks, and Lam Research as well. On to the stocks I'm watching this week. Nvidia, ticker NVDA, is going to be reporting its earnings on Wednesday, with the shares having leveled off over the past 2 months as this year's meteoric growth gets built into the estimates, and investors wonder how much further it has to go. Last quarter's earnings are expected to come in at $5.57 a share. That's growth of 468% over the year-ago period on 277% revenue growth. For the full year, earnings are expected to double to almost $25 a share on $112 billion in sales. Now that growth slows down next year though, according to analyst estimates, with earnings up just 28% on similar sales growth. Nvidia is trading for 38 times its 12-month sales, more than double its 5-year price-to-sales average, and nearly 80 times on a price-to-earnings basis. Of course, the chipmaker has been able to prove skeptics wrong over the last few years, and has seen shares pop in 3 of the last 4 earnings reports. The risk is that over this or the next couple of quarters, those slower growth expectations do start factoring more into the price, and that keeps shares from producing the kinds of returns investors have gotten used to. Also watching business development corporations, or BDCs. This is a whole group of stocks. These are some of the most popular stocks on the channel for their double-digit dividend yields. And an article in the Wall Street Journal last week leads me to believe that they may be getting some big money attention soon. Last week, insurer Aflac bought a $100 million stake in Treeline Capital Partners for exposure into that private credit market. Now, Treeline isn't publicly traded, but it's what the firm is that caught my attention: a lender to small and medium-sized businesses. Now, Treeline may or may not be structured as a BDC, but it has that same business model, and that developing hunger for private credit and its high yields that could bring more funding to BDCs that we cover here on the channel. So I'm developing a whole video on this theme, but I highlighted some of my favorites in a recent video on the highest paying monthly dividend stocks, like here Horizon Technology Finance, ticker HRZN, with its 11.4% dividend, PennantPark Floating Rate Capital, PFLT, with its 11% yield, and Main Street Capital, ticker MAIN, even though it only has a 5.8% dividend, is relatively low compared to the others. Snowflake, ticker SNOW, also reports earnings on Wednesday after rumors broke last Friday that the company was in talks to buy Rika AI for $1 billion to expand its capabilities in generative AI models. Now, if consummated, the addition of Rika's language models would be a good complement to Snowflake's cloud services and its own language model, Arctic. Q1 earnings are expected to be up marginally, about 20%, with full-year earnings only slightly higher than last year at 97 cents a share, but the company is expected to keep that growing revenue at a 20% plus annual pace, which should help keep supporting the shares long term. Giving you the bigger picture idea here with the SectorSpiders.com sector tracker, we do see that 10 of the 11 sectors finished higher last week, with those economically cyclical sectors like industrials, which was the only sector down, materials, which was only up 0.34%, and consumer discretionary also up 0.34%. All those economically cyclical sectors underperforming. Now, we talked about the weakening trend in consumer discretionary stocks last week, and it does appear that worries of an economic slowdown, while supporting stocks and other sectors on those rate cut hopes, is still hitting some of these economically sensitive sectors. On a longer term trend, as that hope for those lower rates does persist, it should support rate sensitive stocks in utilities, real estate, and financials, along with those growth sectors like technology and communication services. Stocks in the utility sector are now the top performers, up 14% for the year, and though real estate is the worst performing, down 3.25%, I expect the turnaround to begin within the next quarters. Valuations are very attractive here for real estate stocks for those long-term investors in it, and we're starting to see large institutional buyers come into the property market on some of those bargain basement prices. Join me on the Blossom Investing app with the link below and see the stocks I'm buying, along with 90,000 other investors in the app. It's totally free to use. Just look for that link, or click on the video to the right for the 5 dividend stocks to buy before the companies buy back their own shares. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.